Good morning and good afternoon, everyone. My name is Al Pontius, and I'll be your host today as we look to give you an update on where we see the year. We'll take a look back at the year, talk a little bit about the fourth quarter, and certainly try and make some comments about 2013, which is right around the corner, of course. Before I get started, I want to make sure and introduce my co-hosts and colleagues. To my immediate right, Bill Hughes. Bill heads up our capital group and oversees all of our debt services and leads our team of professionals that is arranging new debt for clients looking to refinance properties as well as place new debt on new properties. And to my far right is Hessam Nadji. Hessam is the leader of our research services group and will be taking us through a little bit concerning the economy and taking a look at what the impact is there as we start to break down into the debt markets and then further into the capital markets of trade. So without any further comments on my part, I just want to give you one invitation. You'll be able to submit questions throughout the presentation, and what we hope to have is ample time to answer all of your questions as we get to the tail end of this presentation. We'll stay on as long as we have questions coming in. So without any further opening on my part, I want to pass the baton over to Hessam, and if you'd walk us through the economy, please.
Great. Thank you, Al. Good morning and good afternoon, everybody. It's a pleasure to be part of this program again. We come to you at an interesting time, both economically and politically, and there's a lot of question marks about where we're headed in 2013. And my job today is to attempt to answer some of those key questions. As everybody knows, the most important news since the last update that we provided of late is the Fed action to continue to support the recovery and send a message of accommodation. Quantitative easing round 3 was announced not too long ago. And besides the $40 billion per month of mortgage bond purchases by the Fed, the significance of this particular round has to do with the fact that they have not given a deadline to this program and have extended the period by which they're going to keep short-term interest rates low to 2015. In addition, they also had some specific stated goals, which is rather unusual for the Fed. And the combination of all these messages really give us the indication of how ready, willing, and accommodative the Fed remains. Another significance was the timing. This came on the heels of the European Union Central Bank finally declaring a backstop to the contagion possibility of the European debt crisis by announcing a bond buying program for its weakest countries. That was significant as the European Central Bank had resisted going to that measure, but it became inevitable that they had to basically announce that level of backstop to limit the depth of the recession in Europe. These two events are very positive in the sense that they reduce, not eliminate, but reduce the amount of global uncertainty that's basically haunted this recovery, not just in the U.S., but throughout the globe. And it gives us a little bit of a more positive sense that with this attitude coming from the central bank in Europe and central bank in the U.S., we might get a little bit more confidence. Businesses may have a little bit more willingness to expand and hire going into 2013. And overall, the message has been very positive. If you've been following our reports and our webcasts over the past 2 years, you know that we have defined the problem as one of a crisis of confidence and really exhaustive uncertainty, keeping an otherwise organic process of healing and recovering in the U.S. economy limited and muted. We still believe that's been the case. If you look at the economic fundamentals in the U.S. coming out of this Great Recession, coming out of the most severe downturn we've had on record since the Great Depression, you see that both on the consumption side, the graph that is illustrated here was one I've always used in illustrating the point that the U.S. consumer is back. Retail sales are now about 8% above where they were at the 2007 peak. Even on a per capita basis, they're about 5.5% to 6% above the 07 peak, which is a very important footing for the economy because consumption accounts for close to 70% of our economic activity. If you look on the job creation side of the equation, the message has been one of continual disappointment. Coming out of a severe recession, you would expect very healthy job growth. Of course, we were saddled with huge public and private debt, and all the different aspects of this global downturn have held us back. Well, even with that, if you look at the last 12 months through September, we added close to 1.9 million private sector jobs. That should really be another million jobs stronger. In a normal recovery, we'd be adding close to 3 million jobs instead of close to 2 million jobs in the private sector. But there's a couple of very important points if you look at the patterns of job creation. First of all, it's very broad-based. If you look at the leading job growth sector, professional and business services added over 500,000 jobs in the last 12 months. Education and healthcare added about 420,000 jobs. Trade, transportation, utilities, over 300,000 jobs. Even manufacturing added about 175,000 jobs. All of these numbers speak very well to industrial demand, to movement of goods, to office space demand. So the foundation of an office and industrial recovery and then expansion is being laid as we speak. Even financial activities added some jobs over the past 12 months. So again, the foundation has gotten healthier, the foundation has gotten stronger, but what continues to hold us back are these macro concerns and the uncertainty in the marketplace that is sort of anchoring the pace of recovery. So if you look at job creation patterns by metro, very interesting trends to observe. Energy, trade, technology are really the leading drivers. So the metros that are closely tied to those sectors are doing very well. Texas, in particular, is doing great. Both Houston and Dallas are adding very large numbers of jobs. New York and Los Angeles are leading markets with 70 to 80,000 jobs, respectively. Phoenix, Seattle, San Francisco have really joined the leading markets, particularly if you look at a market like Seattle or San Francisco that has not just a tech but also financial services and other kinds of activities as its drivers are now among leading markets. Markets that are still lagging, which are shown on the right of this graph, are saddled with either no major drivers, a lot of the Midwestern markets that still haven't really benefited from the manufacturing improvement that I talked about earlier, and markets that were hit so severely with the housing crisis. Florida, in particular, has not joined the recovery yet. We believe 2013 will be the year for the Florida comeback to begin to really show up in the numbers, but that hasn't hit yet. What's interesting is if you look at some other markets, for example, Detroit and Atlanta would be close to the left side of this ledger, the leading markets, with about 30 to 35,000 jobs each. So even markets that were hit very hard for different reasons, Detroit in particular, is now on a much more positive trajectory. So not all markets are equal, and it's important to really dissect the local drivers, but there are plenty of markets that are now showing signs of very good economic life. Another very important pattern of economic activity, job creation, that really speaks to the future of office demand and how quickly we can start to see improvement on the office side is the employment growth by size of company. And if you look at this chart, we have a very detailed breakdown of the different size companies that have been adding jobs lately. And of course, the mid-sized companies in the 50 to 250 really show up as the leaders of job creation since the bottom of the recession, followed by those companies that have 250 to 1,000 employees. Those are in the red and yellow. What's really important is to see the broadening of job creation among small and micro companies. The great news here is that the micro companies, the 1 to 10 employees, are almost done bleeding jobs, but they've still continued to bleed jobs. That level of entrepreneurial business formation and creation is the bread and butter of the Class B, Class C, lower cost office space, and we need to see that turn positive. The good news is that the next level up, the 10 to 50 size companies, are adding jobs, have been adding jobs, and hopefully the pace of job growth in these small bread and butter companies will continue to grow because it's that backfill that we need to see that broadens the recovery. Overall, the picture for the office market has been one of very gradual improvement. You would ask why the 515,000 professional services jobs that we just talked about a few minutes ago and the financial services jobs that are now positive are not translating to more direct, stronger absorption numbers. And the reason is excess office space even since the Great Recession, change in attitudes of companies still being very conservative about space consumption, and the differential between the Class A sector, where the larger companies that are doing better, as shown in the prior graph, are taking advantage of reduced rents and higher vacancies and are taking more space. But the bifurcation in the marketplace between the haves and the have-nots from a corporate balance sheet perspective and profitability perspective really is what the office market is mirroring. So we're seeing a gradual recovery continue. We've had several quarters of positive net absorption at very low levels. And I think what is reasonable to expect going into 2013 is that with the burn-off of excess space, even the same levels of job growth, or hopefully moderately better levels of job growth, are going to translate more directly into net absorption of office space. So you can see the Class A vacancies coming down, Class B vacancies coming down a little bit, B and C vacancies coming down a little bit slower, and the greatest pattern on this chart is the lack of new construction. We really have no speculative new construction on the horizon to the level that could become an obstacle to this recovery. So the stage is set. We just need to see more transmission of jobs into net absorption of space and better job numbers, which we anticipate to see at least moderately in 2013. On the industrial side of the equation, the picture is a little bit brighter. We've burned through the excess overbuilding that happened going into the recession. We have now seen the movement of goods and global trade, domestic movement of goods as well, pick up pace at a very, very healthy rate. And the mirroring of the retail sales with what happens with just-in-time inventory, warehousing, and port activity has really helped bring down the industrial vacancy rate. And let's not forget that the positive manufacturing numbers are also a plus for industrial. So you can see the vacancy rates coming down much more rapidly. Again, lack of speculative construction is another key to the ongoing development here. So in summary, what we're expecting to see going into 2013 is moderately better job numbers. But the one thing that we have hanging out there is the fiscal cliff. One of the things that could change this cautiously more optimistic expectation for 2013, as we've gotten the clarity from the Fed, we've gotten clarity from Europe, we still have the fiscal cliff, which is a combination of Bush-era tax cuts expiring and automatic spending cuts going into effect as of January 1, 2013. If that is not addressed, postponed, or at least minimized, that would be a major threat to the current recovery. Absent that, assuming that something is done about that, we believe 2013 will be a moderately better year than 2012. The organic economy is ready to go to the next step. The question is, are we going to see some of these global headwinds reduced?
Thanks, Hessam. I'm curious before we move on to Al, but the reality is, particularly since you brought up fiscal cliff, you were just spent some time with, I think, 11 congressmen and senators at the National Multi-Housing Council, and I know it doesn't necessarily apply to office and industrial conversation, but the bigger picture with fiscal cliff is, what are lawmakers doing? What are they thinking about? Do they give you any sense of concern that we're going to come to January 2nd and not have a plan? What sort of relief? Is it good, bad?
Sure. Great question. We were part of the NMHC board meeting that had a 2-day session with a variety of lawmakers. And having come out of the experience we had last year with the debt ceiling debacle, which led to the downgrade of the U.S. debt, the message that we heard loud and clear, which may mean nothing given the political environment, is that everyone recognizes the severity of the fiscal cliff. And if left unchecked, it will threaten the recovery. I think the magnitude of the problem is well understood by both sides. Now, in a lame duck session post-election, can the two sides come up with some kind of at least a temporary resolution? That remains to be seen. But the tone certainly was one of, we can't let this be ignored.
You know, I've got to believe that the period between the election and January 2nd is going to be a really interesting period in the history of this country in terms of the economy and what happens. I certainly have some concern myself, not overwhelming. Hopefully there's a solution on the horizon, and there's obviously a number of scenarios that might play out relative to that as it impacts both office and industrial.
Right. We'll have to wait and see how they deal with it, because it's a very important issue.
Well, I think that what we'd like to move on now is sort of a capital markets overview, if we can. And with that,
Bill, I'm actually going to jump in and interrupt you for just one quick second. I apologize, but you made me think of something in talking. We have typically talked a little bit about the housing market. And one of the comments that we've made really on multiple occasions is the vibrancy of the recovery would have to have strength in the housing market. Otherwise, it would be virtually impossible. We didn't really talk about it today. So it appears we're getting more positive information about the housing market. So can you comment on that? And then further, why do we care given the office and industrial discussion that we're having?
Great question. And it ties back to some of the Fed actions and some of the stated goals by the Fed. Housing is incredibly important to the broader economy. In every recovery, going back to the 1950s, housing has been a major driver of pent-up demand being released, because you have to remember, for every house that's sold, there's furniture sales, there's moving costs. It has a ripple effect throughout the economy. And by this point along the average recovery, housing would have accounted for some 35 to 37% of the growth in the economy. In this cycle, it accounts for less than 15%. So it's been absent as a major driver. Right now, the residential investment part of the GDP calculations is accounting for less than 3% of the total economic output. At peak, it was over 6%. Whereas exports, for example, are accounting for close to 13% of the economic output. So housing has been absent. And the good news is it's no longer a drag. It is beginning to recover. And the Fed has an agenda of specifically trying to spur home buying and an organic housing recovery based on an incredibly, sort of a affordability pattern, as well as very, very low interest rates. They stated that as a goal. The problem is people are still having a hard time qualifying for loans because the underwriting is still very, very tight. But I think going into 2013, you're going to see more contribution from housing because we have seen the bottom and we are seeing an improvement. And as that 2% contribution to the economy goes up from there, you're going to see the broader economy benefit from housing as a contributor. It's important for office and industrial and retail, of course, because it really helps create jobs. They may not be direct office-using jobs, but the movement of people and the mobility of different individuals around the country, chasing jobs that are open, for example, in the end helps commercial real estate in general.
Great. Hessam, thank you. Bill, now I'll let you run with your portion.
Well, I've got to tell you that I would start by saying that I hate to be a bit of a broken record here, but looking back over the last 6 months or so, other than a little bit of interest rate volatility, there's really been very little change in the marketplace from my perspective. So this morning we'll try to talk a little bit about interest rates, availability of debt and equity products, capital providers, challenges we see in the property sectors, and it will give you some thoughts about where we think the market will take us over the next 6 months or so. Historically, as we all know at this point in time, interest rates have really been a driver to the current market. They've increased market activity, returns, they've had impact on value, generally improving property fundamentals, certainly have supported renewed lender consideration for the two sectors. Availability of debt, however, continues to be a bit of a tale of two cities, and we've talked about that before. Deals getting done are being done in larger primary and secondary markets. Quite frankly, capital is generally available for A to B class assets. Very spotty for less quality assets in smaller markets. Deals are being done, but it's a greater challenge. And then when we look at underwriting, I think underwriting's staying relatively constant as well. Lenders are focused on stable income streams, as you might expect, and certainly strength of occupancy. Stable tenancies translate today into lender confidence. Lender confidence translates into a focus on the two sectors. Debt yields of 10 to 11%, translating into debt service coverages of 1 or better, are sort of starters into the sector. And those starters then produce loan to values of typically 60 to 70% in straight debt financing. The capital stack is really very well served in the marketplace today. Life insurance companies, really international, although they've fallen back a little bit. National, local, and regional banks have played a significant have participated significantly in the capital stack. Certainly CMBS and private and public funds have also participated in providing debt and equity into the sector. So I wanted to take a look this morning to give you some idea of who the players have been over the last, certainly the year to date. You can obviously look back in this case to 2008 and see the changes. Commercial banks have played the largest role in the financing for both office and industrial product at 45%. In the office sector, a significant portion of that was international banks, which have slowed somewhat. It's been picked up by national and regional banks. Those numbers are followed, and providers have been followed by life insurance companies at 22% for office, and certainly in this case you can see 26% for industrial. I think the story today is CMBS issuers have provided 19% of new originations for office and 11% for industrial. We'll talk about that in a minute. But we do expect these trends to continue into the foreseeable future. As I've said, the one bright side spot really today might be CMBS, as it will certainly increase its volume into both sectors, especially the office sector. So I wanted to take a little bit about interest rates. Before I really get into interest rates, I really want to talk about stimulus. Obviously, this graph shows a relationship between stimulus programs, better known as QE1, QE2, Operation Twist, and now QE3 versus U.S. employment and the 10-year Treasury. If you follow the red line, which is significant here, you'll see what I'm talking about. The U.S. employment rate against the different stimuli, there's a clear direct improvement at the inception of each round of stimulus. If you look at the vertical dotted lines or slash lines, you'll see that improvement. And as one might expect, the yield on the Treasury did increase a little bit as stimulus created a feeling of, hey, we're going to get better, things are on the move. It certainly encouraged investors to move to higher yielding, slightly riskier investments in this case. Operation Twist, announced earlier this year, helped flatten the yield curve as long-term yields have fallen to historical lows. And then we get into, so what will be the legacy of QE3? We'll talk about that in a moment. Hessam really highlighted that. It will most likely have less impact than some of the other stimulus programs, although a specific impact on the residential sector, construction, and construction employment sectors could be very meaningful. I also wanted to take a look, and we've shown this slide before, core inflation versus 10-year Treasury. If we go out 40 years, there's only been 2 times where inflation has exceeded the 10-year Treasury yield. 1975, where we had runaway inflation just under 12%. 1980, where inflation really surpassed 13.5%. But over those 40 years, this is really the first time we've seen the crossing of those lines, really driven by a fear factor as there were issues, European debt crisis, our own choppy economy, just a fear of global political impacts. It really did impact, and so we crossed that line. Today, both are still pretty much below their historical lows. The 10-year Treasury yield at 174. I think this morning before I came in, I checked, it was 172. Sits below core inflation. The Treasury is below its 10-year and 40-year averages of 3.75 and 7.06, respectively. And really, even if you look over a shorter period of time, below its 2.5-year average of 271. So it does give you just a sense of when the ship writes where we will head with the 10-year Treasury, and I think that's significant. I wanted to take a look at delinquencies. I think it's important that we kind of throw this in. We've done this in the past. Obviously, if you look at the right side of the curve, We see 30-day delinquencies are pretty ragged, particularly over the last, let's face it, over a long period of time now, since 2009, they've increased. They've moved around a little bit. Overall, the percentage of securitized commercial mortgages classified as 30 days late decreased by 14 basis points to just under 10% in September, following a 21 basis point dip in July. I think that's the positive of this. This improvement following a pretty consistent increase in delinquency January through June, when we hit a peak of 10.34% on an overall basis. As a general statement, we continue to see lenders dealing with default issues on a one-off basis without any real wholesale panic. That's good news for us. Certainly with an approach that maximizes returns to the lender. So I talked about the impact of CMBS and what it does for us. From death in 2008 through 2010, CMBS issuance emerged last year with what turned out to be really a disappointing $32 billion, as most of us thought the volume would approach 50 to 60 billion. While year-to-date issuance, according to Commercial Mortgage Alert, of $31 billion has surpassed last year's volume for the first 9 months of $27 billion. Certainly recent benchmark AAA pricing levels and bond yields in general have brought a resurgence to the market and certainly new issues. With over $4 billion in new issuance expected this month alone, the fourth quarter is looking like it has a realistic chance to hit $15 billion. That would bring the yearly total of $46 billion as certainly a substantial improvement for where we thought the year would end just several months ago. That is really very good news for us and good news for the office industrial sectors in particular. Make no mistake about it, a little rally in the marketplace is a positive thing for us. So let's look at why CMBS increased, particularly lately. We've seen certainly a resurgence in new origination, and the reason for that is depicted really pretty well in this graph. In most recent issues, AAAs were priced recently, moving from 100 over the last few weeks down to as low as 80, 85. That's a 20 basis point improvement in the AAAs. If you look even further down, we've seen consistent improvements, not only in AAAs, but AAs, 30 to 40 basis point improvement. In single A's, we've seen a 50 basis point improvement. And most importantly, in BBB minus, we've seen improvements of over 100 basis points. The pricing rally that started in June has certainly built confidence in profits amongst users. Certainly, this pricing rally, once again, has really impacted the marketplace positive. So lastly, I want to talk a little bit about investor considerations and lookout in this slide. I think certainly it's important to realize that the market should remain stable. We expect it to remain stable for the foreseeable future. We are facing still a rather choppy domestic economy that's going to cause interest rates to stay relatively low. Employment numbers are going to slowly improve, we believe, if you listen to Hessam, and I agree with Hessam. Inconsistent economic indices, housing and construction, election are all issues that we have to deal with in the current economy, and we will. Certainly there are global influences as well, foreign sovereign debt issues, economic, geopolitical uncertainty is an issue that we need to deal with. Capital supply should remain healthy, but certainly not for every asset. Life insurance companies will continue to serve the sector. Regional and local banks will certainly be a big play for most of you in this sector. Debt funds, and as we spoke about earlier, CMBS. So let's talk a little bit about investor debt strategies for our properties. $1 to $10 million. Certainly there are some life insurance companies and commercial banks will play in the sector. Typically 65% loan to values, 7 to 7 year terms in this sector with 20 to 25 year repayment schedules. 5-year money's price going to be priced in this sector at 4 to 4.5%. 7-year money, 4.25% to 4.75%. And certainly on these smaller transactions, 10-year money, typically 4 5/8 to maybe 5.5% is what we're looking at. As you move into the next tranche, 10 to 20 million, certainly the availability of capital expands. Commercial banks, regional commercial banks, some national commercial banks certainly, CMBS and life insurance companies, and a few debt funds will provide some bridge financing, finance a lot higher up on the capital stack, and make it easier for deals to get done. This finance is typically, once again, 65% loan to value, 5 to 10 year terms with 20 to 25 repayment schedules. 5 years is going to look a little bit better. 3.5 to 4, 7-year, about 4 to maybe 4.5. 10-year, we're actually seeing money down as low as 4%, with particularly some of the pricing rally and competition created now by the CMBS sector, to typically about 5, 5.25. And over 20 million, certainly a full assortment of capital providers, from large national banks, CMBS issuers, to life insurance companies will play in this product. Best quality assets, A, maybe down to B quality assets. They will provide in both debt and equity. And certainly a lot of sources operating all along the capital stack. You know, we just are in the process of closing a transaction, $80 million Class A office building in California, priced at $260 over the 10-year, 5 years interest only. The client was taking cash out of the transactions. It was a real positive a transaction for us. Things have certainly changed in that regard in the marketplace, and we continue to believe that they will improve, although slowly and dependent upon the economy and a lot of other factors that are going to impact what we do. So with that, I'm going to turn the presentation over to Al.
Great.
Al?
Bill, thank you very much.
Well, before you get started on your presentation, the one thing I know is on everybody's mind is, with all this Fed activity and continual stimulus, are we going to have an inflation problem when the economy starts going? I mean, that is the underlying worry among a lot of our clients. And Bill, can you comment on the inflation outlook? And I mean, just what do you think will happen? Let's assume the economy does moderately better in 2013. We deal with the fiscal cliff, we postpone it or deal with it somehow, and it's not going to derail the economy. What will happen to inflation a year from now?
Well, you know, obviously, in this sector, in our business, I don't think inflation is necessarily bad. The question is it runaway inflation? Right. Is it inflation that's going to impact the business? Is it going to push interest rates out? Obviously, we've talked about a correlation between interest rates and inflation. Certainly, they tend to move in unison as they go up, and should do that. The question is going to be, can the Fed control? They put a lot of stimulus into the marketplace. They've injected a lot of money into the marketplace. At what point in time do they start slowing it down? Do they do it too late? Once it gets going, it's awfully hard to stop. Right. We've seen that historically. So the question is whether or not they can do that. I think there's enough globally going on that even when we see continued signs of improvement in a domestic economy, I think globally there'll still be a flow of capital into our treasury markets, because nothing is going to improve simultaneously. I think we're going to have bits and pieces of things improving as we see now, a little bit of start and stop. So I think the Fed's going to have an opportunity to control it. It's my personal opinion, of course, sure. But that's where I
tend to agree with you, because if they now have the track record of what happened, let's say back as far back as 1994, when the Fed moved too aggressively and almost caused a recession. And then, of course, they left interest rates too low too long after the 2001 recession and the 9/11 tragedies, which led to the housing bubble in many, many ways. So I think there's plenty of pretty recent lessons learned on how to just balance the mopping up of the liquidity. But I think it's a foregone conclusion. The liquidity has to get mopped up very quickly once the economy gets going. And we've already had numerous questions about the fiscal cliff. with our audience wanting to know, if it's not dealt with, what does that really mean? If it's not dealt with, if unchecked, it's about a 5% hit to the GDP or a 5% hit to our total economic output, all coming at once, starting the first quarter of 2013. And it would probably put us into a zero growth or most likely a recession within about 3 to 6 months. And the other alternative is, of course, just pushing it out and kicking the can and buying, let's say, 6 months or a year until the new administration, whichever side that goes to, takes hold. And that is probably the most favorable to the economy in the short term, because we're still coming out of it. We're still in a very fragile state. But the concern is that if it's just a postponing of the whole issue, we might get another downgrade, which has financial market implications. The most likely scenario is probably a postponement, because otherwise, if the two sides of the aisle will work together on minimizing the effect, doing something, letting perhaps some of the tax increases kick in, but not all, letting perhaps some of the expense reductions kick in, but not all, that would be the ideal balance, where you're not hitting the economy with all of it at once, but you're taking some action that allows the rating agencies to basically stay on the sideline and not do another downgrade. It is so hard to predict which way it's going to go. But if anything, it's probably more likely a postponement, in my view. Any comments, Bill, on that?
Well, I think it's I'm hoping it's scenario 2 or scenario 3. I think it has to be one of those two. Right. But I can't believe it'll just be postponed. I think it has to be postponed with a meaningful game in place, right. And I think it has to be announced. And that's at least what I hope for. I think that sustains this longer. I think it allows for our business to continue to grow in a consistent, orderly basis. And I think that's what we would all really like to see. And hopefully the lawmakers of this country see that as well.
Great. Yeah. Thank you. Why don't I take over for just a little bit then? But let me first say I'm so happy to hear about the questions coming in. Many of you provide us with feedback subsequent to these presentations, and consistently it's that interaction at the end that I think everybody really seems to enjoy and get the most out of. So I won't try and hurry, but I will get through this information quickly so that, in fact, we have some time for that. So let's take a look. Let's take a look at the office market, and I'll start a little bit with the fundamentals. So this first graph that you have up on your screen, maybe I'll give you a minute to absorb it from the standpoint of the last thing you need is me to read numbers to you. But here what you have to the left of your screen, you have the top 10 markets as ranked by vacancy rate, overall vacancy rate, all product classes in office. The top 10 markets on the left, you have the bottom 10 markets on the right. Again, this is 2Q data, and this is as ranked purely by the vacancy rate. Now, I would imagine a number of you are looking at this and saying, wow, I thought this market was performing better than this, or I thought this market was actually lagging a little bit, and possibly there's a surprise to the upside, at least in your own viewpoint. So let me just add a few comments, because there's so much reading between the lines that has to happen when you're talking about such a broad number as the general vacancy rate. So let me start with, if you take a look, for instance, San Francisco. I would say that San Francisco is probably the top-ranked investment market in the eyes of investors today. And part of that would certainly be the fundamental strength. Yet you look at a number like 13.8%, and you say, wait, that doesn't really sound that strong. So just a couple of quick caveats. On a sub-market basis, you will find markets within San Francisco that are literally under 5%. Within the San Francisco metro, you're really talking about including San Mateo and Marin counties. So by the time you lump all of this in and also lump in all ages and all classes, that's where you get, I'll call it the muted effect to the real strength of the market and where investors are headed. I could say similar things about Boston, for instance. If you look at CBD, very strong and near in. As you get out into the suburbs, there is your negative impact. And then finally, maybe just looking and picking out individual markets. If you take a look at San Jose, wait a minute, I thought that was the capital of Silicon Valley. I thought high tech was, if not the driver of economic performance today, certainly a top two. So what's going on in San Jose? Well, again, it's a story of age, class, and spreading the markets. If we were to get into Mountain View, if you will, Google headquarters, Mountain View, Sunnyvale, those combined markets in the A-class sector, sub 5%. So again, it's very, very difficult to look at a broad brush vacancy rate and draw meaning to the for the investor as to where opportunity really lies or where strength really lies. So I just wanted to make a few comments along those lines. I would also point out, if you look at the bottom three in the top 10 list, you're looking at Portland, Los Angeles, and Charlotte. Again, in the top 10 list ranked by vacancy. But in fact, those three markets combined had minor growth in the overall vacancy rate. So again, we continue to be challenged fundamentally in all but a few markets, and within those markets outside of certain submarkets. So we continue to have a fairly challenged recovery fundamentally. And I want to go back, Hessam, to a comment that you made. You had commented on several factors why the jobs weren't still translating, it seems, into a faster recovery fundamentally. And I won't repeat anything you said because I thought you covered it very well. But there's one comment I'll add is we continue to have a downshift in the ratio of employees to space. Mm-hmm. And what used to be the one employee per every 250 square feet worked its way over the past 5 years down to 200 and now really sub 200. It now sits at about 175 to 185, and that's probably going to continue to come down. So the way we use office space is continuing to evolve, and that evolution is companies are getting by on less square footage, even though their headcount stays the same. So,
very good point.
Thank you. I want to make one last comment. I realize I'm staying on this slide a little bit long, but I don't think it would be fair to the audience if I didn't at least touch on medical office. Medical office within the overall office landscape is a bright spot. Overall vacancy in MOB, that's on campus and off campus, overall vacancy 10%. We have a number of markets that are actually below 8%. Of interest, if you look at where the leasing activity is, there's major shift going on in medical office right now. So the numbers could be misleading relative to the overall strength. And here's why I say this. Virtually all of the absorption gains over the past year are in product constructed after 2007. So we're really seeing movement in the medical space in the newer buildings. Ironically, those newer buildings, because that's obviously where all new introduction of products has come from, sits today at 17%, parallel with the general office market. But that number is going to work its way down pretty rapidly. And it also, the absorption figure signifies a major shift in the way medical use tenants are utilizing space. So we don't have time today to really dig into great depth there, but it's really a very dynamic market today and is worth noting on the call. All right, I'm going to move on now to talk a little bit about the industrial market. And there's no question that the industrial sector has really become a darling among investors. Certainly multifamily is high up on the schedule, medical office I talked about. But as a product segment, industrial has become very interesting. And it's easy to see in the vacancy rates why that happens. If you look to the left of the graph, the top 10 markets all below 10%. In fact, all below 9%. If you look to the right, even the bottom 10 markets don't reflect in many cases what you see on the office side of the ledger. And even if you look at some of the markets that are maybe not as attractive as the others in terms of their vacancy rate, i.e. a Detroit, i.e. in Atlanta, i.e. a Dallas-Fort Worth, look at the year-over-year change in that vacancy rate, and you see how rapidly those markets, those weaker markets fundamentally, are actually improving as we speak. So it's really a bright spot of the investment landscape, and you see capital flowing into industrial for exactly that reason. Now, we may see some slowdown on the fundamental recovery. The real strength of the industrial market, in addition to this modest economic recovery that we have had, as Hessam pointed out in his slides earlier, is the introduction of new supply. speculative construction has been almost non-existent for the better part of the last 4 to 5 years. And although that is starting up in a few select markets, it is just that, a very selective basis. Just the same, if we take a look at port activity, we see a relatively flat line. You can see the United States average, and really some of these markets have to be combined. In other words, you would put Los Angeles with Long Beach. And when you combine the year-over-year activity, you have barely over a 1% gain in goods flowing through those ports. Same thing in Seattle, Tacoma. These markets would have to be combined. So really, the growth factor in the ports coming off of a significant jump off of the extreme lows of 2009 and into 2010, we now see a flattening out of that growth rate. And GDP, more than anything, is going to have to accelerate a little bit if we're going to start to see a little bit more rapid gain on the industrial side. But again, the supply side is so supportive. That's what makes it so attractive in the eyes of investors. Now, I won't spend as much time on transactional velocity, but I'm asked the question frequently, what's the mood of investors? How do they feel? We've just talked a little bit about still some choppiness fundamentally, absolutely on the office side, better on the industrial side, but transactional activity is rebounding very impressively. We've seen transactional counts grow by 45%. I'm talking at $5 million floor and up. We've seen transactional counts grow by 45% year over year through the third quarter. That is significant. Now, many of you, and I will come to this in a minute, many of you might be used to seeing this expressed in terms of dollar volume. The reason we will always express this in terms of transaction count is so that the data is more reflective of the pace of activity. If a billion-dollar portfolio changes hands, if a $200 million sale changes hands, those can inflate the dollar volume numbers very rapidly, yet they don't necessarily explain the story of trading activity. And what we see here is a clear pickup in trading activity. In fact, through the third quarter, we are rapidly approaching. We are just shy of where we were in all of 2011. So we've really seen some nice gains. You see that on the office side. On the industrial side of your graph, you see the same thing, slightly less. Obviously, the trade velocity industrial is not quite the same. That gain is really about 15%. But again, it's up. I should also point out that particularly going back to the office side, it's really across the pricing spectrum. So we're seeing this pick up across the board. I'll stop briefly on a dollar volume basis. Again, many of you are used to seeing this type of information expressed in terms of dollar volume, so we want to offer you that view as well. Office activity in terms of dollar volume up about 30%, industrial activity up about 20%. So again, pretty healthy gains year over year through Q3. Anecdotally, I can tell you that we feel busier as we head into the fourth quarter. I have had an opportunity to visit with a number of you as I travel across the country, and anecdotally, many of you, frankly, the majority, is expressing to me that you feel activity is picking up on the leasing side. You're in more interactions with tenants. You're seeing some expansions. You're certainly seeing the migration from maybe a lower grade space, taking the opportunity to move to a higher grade space. Transactions speak for that confidence. The reason you see transaction growth is growing confidence in the fundamental recovery finally kicking in. And that would be despite certainly some headwinds that you were talking about earlier, and we may get into some questions. So let's take a look at the relationship now between pricing, cap rates. I won't stay too long here, partly because I want to get into questions and partly because some of these trends remain the same as when we visited several months ago. The transactional line, or rather the cap rate line, continues to reflect a slight depression, but realistically that line is flattening out. Cap rate compression, we can debate this point maybe a little bit. Cap rate compression may still be available in the secondary markets and potentially the tertiary markets, but I'd say we've relatively flatlined as far as cap rate movement. The other problem, if you will, with the data is if you look at a peak transactional level of 2007, that is such a larger sampling of deals changing hands that it expresses differently what's really going on in the market. Here's what I'm saying. The market, according to this graph, has recovered on a price per square foot basis. In office, it's recovered to the point that it's now 80, actually, ironically, it's in both cases, pricing has recovered to the point of 80% of peak values in '07. Here's the be careful part. Better grade assets are trading today still. There is still a reluctance to move into older product, certainly C-grade product. And when I get to my next graphic, you'll see this expressed a different way. But differentiation continues to be significant in the marketplace today. Consequently, the sampling of what is selling today compared to '07 would be a higher grade base. And so it probably skews that recovery number, and I would argue that the across-the-market recovery number is probably a little bit less than what I would associate to the graph itself. And to support that maybe a little bit further, we'll take a look at how the cap rate lines are behaving between the primary market, secondary market, and tertiary markets, both for office and industrial. And I also want to say that this is easily the number one question that I'm asked as I visit with investors and investment groups around the country. Are we seeing any evidence that the market is opening up? Are we seeing investors move into the secondary and tertiary markets? And the answer to that is yes, absolutely. And one more graph will express that even better than this does. So we are absolutely seeing that movement begin. And what you can't see here, because it's very difficult to look at the graph, is I'll just make a couple of quick points. One is you see how narrow the band was if you work your way back into the '06, '07, '08 time period. That's what I refer to as little differentiation. If it's an industrial asset, an office asset, what's the going rate? Today you see heavy differentiation. The investors are far more attracted and far more aggressive in terms of yield requirement in the primary markets and so on. But we have now seen statistically, anecdotally the evidence has been there, but statistically we're now seeing the beginnings of a compression. It's slow, but we're seeing the beginnings of the compression, particularly between the primary and secondary market, still slowly developing in the tertiary markets. And this trend, by the way, this trend that is beginning the process is clearly being led by the private investor that, if you will, is stepping out a little bit earlier in terms of searching for maybe that higher yield and starting to view the risk as not as great as the variation would suggest. Last slide, and then we'll get into some Q&A. This slide expresses a little further what we're talking about. If you look at 2010, broken down by where were investors most active, and we have 10 primary markets. I won't read all of them to you. You can hopefully see those on your slide, but Atlanta, Boston, Chicago, Dallas, Houston, San Francisco, New York, obviously, and so on. The 10 most actively traded markets, how were investors behaving relative to the rest of the country? And what you saw in 2010 is that 60% of transaction activity was actually occurring in those 10 markets, 40% outside. You saw that band get even tighter in 2011 as investors really placed emphasis on safety defined as liquidity, and so you saw the major markets trading way more actively. In fact, 2/3 of transaction activity. Well, here we are through the first half of 2012, and this has shifted pretty rapidly. You see the major markets still the most active, but now down to under 60%. And so that needle is moving pretty quickly right now, and I would venture to say when we get together again in another quarter, that number will move a little bit further. It may not go to 50-50 quite yet, but clearly that trend is in motion. So with that, I've wrapped up my comments about the investment and fundamental landscape, and I think now we've got an opportunity to visit with you on your questions.
Great, Al. Great. We've received a lot of questions from you, which we appreciate. So let me take a few that were submitted by a number of our audience members. Probably the most frequent question asked right in the last few minutes, Al, as you've been talking about the investment market and some of the metro differences, is market selection. What's your viewpoint on market selection? An investor watching the presentation is now seeing the top tier Class A yields compressed back down to 6.5 or 7% in the primary markets. Do you now go to a secondary market that has some job growth, or do you go into the outlying areas of a primary market or look to invest in a B asset instead of an A asset in order to get a little bit better yield? What is your sort of guidance to investors around market and or sub-market selection right now?
Hessam, that question is actually so much more complex than I think meets the eye. And so I want to make sure I don't dodge the question, but I just want to say that you have to look at your strategy as an investor and what you are trying to accomplish. For instance, the primary markets are clearly more liquid. Every time there is concern about the economic environment, worries about where are we going fundamentally, there is a gravitation to the primary market because at least there is a sense that that's where the jobs will be based, whatever they are, and that's where my liquidity lies. So it's not really a secret why that's there. However, let's look at some counterpoints. We see some good activity in other markets. I'll rattle off Salt Lake, Denver, Nashville, Minneapolis, Philadelphia. These are all markets that have pockets of real strength. I was just in Minneapolis yesterday, and the mood I got from the investors I sat down with was not one of doldrums. Really, I felt a very upbeat sense from some improving activity. So we can absolutely get outside the major markets. The other thing that I would point out is the threat or risk of new construction is less the further out you get. So whatever the supply is probably a safer bet for your supply forecast than others. So if you can acquire a building where the rent base is already competitive, where you feel that the asset itself has fundamentally some appeal to the market beyond being a pure commodity, because the commodity stock, I think, is very, very challenged. By commodity stock, I mean 25-year-plus property, not much appeal to the design, immediate amenity package to the building, minimal. In other words, what causes me as a tenant to say, I really want to be there? I think that product is very challenged. But within any community, you can find opportunities to take a look at job formation. You can find opportunities to look at the new supply curve, which in many is none. And there's and by the way, a higher yield. So I think the risk factor is more than worth it, and we're seeing it start to turn up in the numbers. So I don't think there's any question that there are many markets outside of San Francisco, Boston, New York, and Washington, D.C. that investors can look at and really get a nice result from.
Follow-on question to the two of you on that. We have a few investors on the session that are ready to take some risk. They're ready to maybe even explore the tertiary markets, maybe even look at full-scale value-add opportunities. One investor in particular has stated in their question that they have a lot of faith that the recovery will be better in the next few years, and therefore to get ahead of the pack or ahead of the herd, they're looking at some value-add opportunities and possibly tertiary markets. First of all, Al, is it too early to go that far into the office? Because typically the A recovers, then the B gets a little bit better, confidence improves, and so on. But if you step back and take a look at where interest rates are, and if you can qualify and secure very, very attractive financing, there is a very compelling case for being a contrarian in this particular point of the cycle. Do you think it's time? And Bill, can you finance it? Al?
Well, that's an interesting sequence of questions because the is it time part really is very contingent on financing. So I have an opinion and I want to answer it, but my opinion, by the way, is influenced by what is my debt availability. I mean, whenever I'm looking at trying to advise any of our professionals or directly in communication with the clients, it's always a question of what is the debt solution. Because when my opinion is, what do you think about this value? What do you think about where we're going? Without the debt solution, then I don't have an opinion. Because that is a huge driver. So let me first toss you the ball and just say, if we're going to be in a tertiary market, what am I going to hear from the lending community?
Or a full-scale value add.
Or a full-scale value add. But again, you full-scale value add in a tertiary market.
Yeah, that's
kind of the extreme of the,
correct.
Yeah, okay.
Well, I think as I talked a little bit about confidence level and lenders having confidence in the marketplace, I'm not sure lenders have enough confidence to take on a lot of risk. Lenders are pretty risk adverse in the marketplace today. I think that you could take on a full value add in a strong market much more easily than you could take on something in a tertiary market that maybe has a good story. I think the bottom line is that lenders are expecting to be presented with a story, have evidence that the marketplace supports the game plan of whatever it is they're trying to do, whether it's a stabilized hold or whether it's a value add or whatever they're trying to do. So it's not an easy answer. I wish it were black and white. I guess the good news is that's why we have a business, because we need to help our clients find the right lenders and to do that. Certainly, there are lenders that are debt funds, private funds are willing to take on some additional risks. They want additional yield to be able to do that. And sometimes that sort of detracts from the overall investment. So I will say that there is a chance to finance any transaction. The approach has to be that it's got to be a grounded plan in place, certainly an exit in terms of how that investor lender gets repaid back, and they're looking for a health. The greater the risk, obviously, the greater return they're looking to have. But if there's a change in the marketplace and a continuing change that we expect in the marketplace, that's probably the arena that we think that there's going to be the biggest change. Certainly over the next 6 months, as lenders gain confidence, they want to employ their capital, they're trying to make money, and we're starting to see that happen, and it really comes in the form of there's some big banks out there that are doing that, and certainly there are some private debt funds that are in the game as well.
And so now I will go ahead and tack on. I actually happen to agree with the investor that submitted the question. In other words, I really believe there's momentum. Now maybe we're going to come back into the economy and talk about the extreme risk factors that could really throw it off.
Scenario.
But if you look at the supply curve over this extended period of time, and if you couple that with extreme introduction of new supply, it just feels like that's just not a reasonable forecast. Right. So if I can move into a tertiary market, and there are a bunch of ifs, because my liquidity for sure will be less. So as long as I can handle that, but if I'm in a 3 to 5 year turnaround situation, and if I've got a market that's working its way back to a more optimistic period, in other words, I won't go back in the slides, but you remember how narrow that band was between the primary market and even all the way out to tertiary. Will we go back to that kind of relationship? I don't know, and I suppose I kind of doubt it, because I think differentiation has always been a part of the market. But there is no question that if I can move into a market and prove to myself that I have some leasing momentum building, and I believe the market is going to further assist me as I move forward. New construction's not coming in. My embedded rents are in a good position. Maybe I can renew a few leases, move a little bit of vacancy in, I'll call it a conservative underwriting, and hopefully be conservative on my exit. If I'm envisioning selling in a tertiary market at a 6 cap when I've stabilized it at 95%, then I think that my model is broken. Right. But if I can move in at a reasonable return going in, it depends on the circumstance, but let's just say 8. And if I can turn that product around and sell a more stabilized position, not 95%, but if I can sell a more stabilized position out at 8.5 to 9, then I would say that particular investment has a real good chance in the 3 to 5 year horizon.
Of course, it has to do with the market drivers. I mean, some tertiary markets
absolutely
have no economic drivers on the horizon. You have to be careful there. It seems to me that the fact that the office market in particular, to a less degree, industrial market, have lagged, let's say, the apartment market, both in the fundamentals recovery and capital flows coming in, is actually a pretty compelling advantage now. That if you believe that the economic recovery will stay on track, and potentially get better. Even if it doesn't get that much better, we get 2 million jobs a year, a little bit more translation of jobs to office space demand in particular. Industrial market seems to be doing much better today than it was even a year ago. With interest rates locked in at these current rates, and if you can be around any kind of a location that has reasonable economic driver connectivity, whether it's job nodes, whether it's ports, whether it's a strategic warehouse distribution location and so on, it's an amazingly opportunistic time to lock in that debt, get into the sector, and do a good job of repositioning or moving your assets forward through ground-up organic demand. And it seems to me, Al, that you're concerned about square footage per worker, which is real. I've even heard studies that are more dramatic than some of the trends you were talking about, as low as 150 square feet per worker. Even with that, if we get to a normal recovery, or a recovery that becomes more of an expansion, instead of 2 million jobs, we create 3 million jobs. If that top-line number starts to improve and become more normal, like it should be, even those structural trends that are very real, I think are not going to become the obstacle to a pretty good recovery, especially because of what you said about supply. The new supply is just not there. So within the next 2 to 3 years, I think we're going to look back and think this was a really good opportunity to get into the office, and especially in the industrial market, because the risk profile is less. Had one more question come in that has to do with the notion of where the demand is going to come from in terms of the B and C assets. We talked about small to mid-sized companies, but a lot of the audience members want to know your perspective, Al, as you travel around the country. Are you hearing broad-based leasing activity, or is it just giant corporate leaders, Fortune 500, Fortune 100 types of companies that are dominating the leasing activity?
I don't think it's quite as extreme as that, but there is no question that the larger floor plate assets, larger users, lack of supply of larger space compared to the supply of smaller spaces is such that the bigger space assets, again, everything has to be so qualified today, but quality assets, they're getting better action. We have still seen small businesses struggling, and until that changes, and that's where the B and the C come in, because they are the low-price alternative, especially when the A's run away. Look, maybe we don't need the shiny image. We're a small business. Cost containment is a big issue for us, so let's look at B and C. Not only are they looking at cost containment through their real estate, but they're also looking at, these are typically companies looking at smaller spaces that don't have the luxury, if you will, of placing a super high premium on the image of their actual space. So until those smaller businesses are moving along a little bit, that's certainly, but for a few markets, that's certainly where you see slower activity actually than the larger. So it might not have to be Fortune 500 and mega, but these smaller companies, smaller businesses are much slower in formation still.
We've received a lot of questions. In the interest of time, we need to wrap up the session, but we will respond to your questions via email, and I'm going to turn it over to you for closing comments.
All right. Well, again, and I'm going to take off of what Hessam just said. By all means, please, if you have additional questions that maybe we've stimulated, certainly those that we weren't able to get to, we'll look forward to getting back to you. I just want to say once again, thank you very much for entrusting some of your day to us to try and talk through the markets a little bit. We look forward to being in touch with you again very soon. Thank you.